Good afternoon, everyone, and welcome to today's webinar, Budgeting Fundamentals for Non-Finance Professionals. I'm Tariq, and I'm thrilled to be your guide on this journey through the essentials of budgeting that are crucial for professionals from all walks of the business world. You might be wondering, why budgeting? Well, whether you're an entrepreneur, a manager, or someone in a non-finance role, understanding budgeting is like having a compass for your organization. It helps you navigate through financial challenges, make informed decisions, and ultimately contribute to the overall success of your team and company. Over the next half hour together, we will delve into the foundations of budgeting, introduce the financial statements, explore the process of creating a budget, and provide some practical tips for effective budget management. Whether you're new to budgeting or looking to enhance your skills, this discussion would hopefully be a great added value to you. But before we dive in, let's take a moment to recognize why budgeting matters. Budgets serve as a roadmap, guiding us towards our financial goals and helping us stay on track. They provide clarity, empower decision-making, and offer a strategic framework for success. I want this to be an interactive session, so please feel free to ask any questions throughout the webinar using the chat feature. And we will also have a dedicated Q&A session, so make sure to write down any thoughts or questions that come to mind, and we will discuss them by the end of this webinar. Without further ado, let's embark on this journey into the world of budgeting fundamentals. Budgeting is the process of creating a plan that outlines the company's financial goals and the various steps it will take to achieve them. It is essentially a financial roadmap that helps guide decision-making, allocate resources, and ensure that the organization is on track to meet its objectives. Now, you might be wondering, why is budgeting so crucial? And what are the critical functions of management in creating a strategic budget? Well, let's explore this a bit further. Consider budgeting as a bridge between where your organization is today and where it aspires to be in the future. It aligns financial activities with the strategic goals of the organization and ensures that every financial decision contributes to the overall success of the company. It also serves as a strategic tool, aligning financial plans with the broader objectives of the organization. It also helps in performance evaluation by serving as a yardstick for estimating achievement. By comparing actual results against the budget, you can identify areas of success and areas that may need attention. Budgets also provide a basis for decision-making. They offer insights into the financial health of an organization, helping you make informed choices that drive growth and sustainability. Creating an effective budget starts initially and fundamentally with establishing a strategic plan. In order to do so, every institution needs to begin by identifying its current position and status quo and map it to its desired strategic objective. So accordingly, let us divide the planning categories into 4. Whenever we start with the big vision, we call it a strategic plan. This is a broad, long-range strategy in which we set goals for 7 to 10 years ahead, and it's mostly entertained and created and implemented by top managers. Then we can move on to the medium term, where we can discuss the tactical opportunities or tactical planning. In this section or in this type, usually the activities are more specific, are more medium range, and the objectives are identified more clearly, and this is mostly handled by lower managers. Then we can move on to the third, which is the operational planning or operational strategy, in which we handle the day-to-day operations for the next year. So it is the most imminent part of the business that everybody is handling. And eventually, definitely, we need to have something called contingency planning, in which we put some backup plans. So plan A, plan B, or plan C, in case any of all of the primary plans fail to be executed. The planning exercise is initiated with a rigorous analysis based on the examination of the internal and external factors impacting the success of the entity. This is usually followed by the identification of the strength, weakness, opportunities, and threats, or what is also known as SWOT analysis. Once identified, the strengths need to be maintained, developed, and leveraged, while the weaknesses need to be remedied and stopped. The opportunities need to be prioritized and optimized, and the threats need to be countered and controlled. Then comes the definition of the mission and vision. A mission statement is a concise and inspiring declaration that outlines the fundamental purpose of an organization. It answers the question, why does the organization exist? And describes its core reason for being. A well-crafted mission statement communicates the organization's values, goals, and the primary beneficiaries of these activities. A vision statement is a forward-looking aspirational expression that articulates an organization's long-term goals and aspirations. It outlines what the organization aims to achieve or become in the future. A well-crafted vision statement should be inspirational, motivating, and provide a clear picture of the desired future state. Once identified, we need to explore how this can be translated into strategic objectives, the SMART objectives of sorts. When we say SMART, it does not only mean intelligent objectives, but it also is an acronym that means that objectives need to be specific, measurable, achievable, relevant, and time-bound. The SMART objectives need not be only financial objectives. They can be financial and non-financial in nature. Some examples would be of the financial objectives: growing earnings per share 15% annually, boost annual returns on investment from 15% to 20%, increase annual dividends per share, strive for stock price appreciation equal to or above the current average, or maintain a positive cash flow. On the non-financial side of things, our objectives could be to increase the firm's market share, overtake key rivals on quality or customer service or product performance, or attain lower overall costs than rival, boost firm's reputation with customers, etc., etc. While it may seem trivial that all non-financial objectives have a financial impact, we need only here to cater for the objectives that are mostly related to the non-financial metrics. So mostly reputation, mostly presence, mostly leadership, maybe customer satisfaction, maybe excellence and quality, or growth opportunities and establishing them, etc., etc. And then, to effectively monitor our budget, we need to focus on key performance indicator or KPIs. These are the metrics that help you gauge how well you're sticking to your financial plan. So some common KPIs could be variance analysis, comparing actual results with budgeted figures to identify differences and actually treatment methodologies for these differences or action plans. Some profitability ratios could be also the KPIs to assess how efficiently the organization is generating profit. Some cash flow metrics maybe as well to ensure that our cash flow aligns with budgeted projections, and even some expense ratios to analyze the proportion of expenses to revenue in different categories, etc., etc. This is not really a defined spectrum. It is mostly related to each and every organization based on their strategic objectives and targets. After we are done with planning, then comes the time for organizing resources or resource allocation. Resource allocation in budgeting is a critical aspect of effective financial management. Think of budgeting as a tool for effective allocation of human resources, capital resources, natural resources, and ideas. It helps you determine where to allocate efforts, whether it's for marketing initiatives, new projects, or day-to-day operations. The key considerations and principles related to resource allocation in budgeting are strategic alignment. So, Our resource allocation should align with the strategic goals and priorities of the organization. It should ensure that the resources are directed directly towards the establishment of the activities that contribute most significantly to the overall mission and vision. Another consideration is also prioritization, in the sense that prioritizing resource allocation involves identifying and focusing on the most critical needs of projects. It helps organizations concentrate their resources on high-impact initiatives, ensuring efficient use of limited resources. It could also promote flexibility. Budgets should allow for flexibility in resource allocation to adapt to changing circumstances. Flexibility enables organizations to respond to unexpected challenges or opportunities without being constrained by rigid budget structures. It also allows us to handle the cost-benefit analysis. Organizations should conduct a cost-benefit analysis to evaluate the return on investment for different resource allocations. This analysis helps us identifying the most cost-effective strategies in order to maximize the impact of the intervention of the available resources. It also helps in departmental collaboration and ensures a holistic view of resource needs. It promotes a unified approach to resource allocation, preventing siloed decision-making and fostering better coordination. It also helps the employees increase their ownership into the strategic plans of the company. Employees being closer to day-to-day operation can provide also valuable input on resource needs and allocation priorities. It definitely also ends up with continuous improvement. Continuous improvement ensures that resource allocation practices evolve to meet changing organization dynamics and priorities. Then comes the budget implementation, which is the most essential part, obviously. Budget implementation is the phase in the budgeting process where the plans outlined in the budget are put into action. This phase involves executing the strategies, initiatives, and allocations that were established during the budget planning and approval stages. Successful budget implementation is crucial for an organization to achieve its goals and objectives. Effective budget implementation is a dynamic process that requires collaboration, adaptability, and continuous monitoring. It is the bridge between planning and achieving the goals, and successful implementation is vital for the overall success and financial health of an organization. A very important step that we should not take lightly is the budget monitoring and control. The importance of monitoring the budget versus actual performance cannot be overstated. Let's start by understanding why monitoring your budget versus actual performance is so vital. Regular monitoring allows you to make informed decisions based on real-time financial data. It provides insights into what's working well and where adjustment may be needed. It also helps in setting strategies to adjust the budget when needed. It also helps in the regular reviews to schedule periodic reviews to catch discrepancies early. It also helps in scenario planning to anticipate potential changes in the business environment and create contingency plans. And it definitely helps ensure effective communication with the team to promptly address any issues. Once we have identified the points of difference, it will help us refocus and adjust the budget based on the new information or changes in the landscape, in the business landscape. Imagine a company that identified a significant variance between their budget and actual expenses. Through regular monitoring, they discovered an unexpected increase in raw material cost. By promptly adjusting their budget and negotiating new contracts, they would successfully mitigate the impact on their overall financial performance. Practical cases like this showcase the importance of the budget monitoring in responding to real-life challenges. Let us start by discussing initially the different types of budget. And there is no one-size-fits-all approach in budgeting. Different types of budgets serve various purposes within an organization. Let us start with talking about capital budgets. The capital budgets, or CapEx, they deal with the long-term investments in assets like machinery or infrastructure, whereas the operating budget, or OpEx, focuses on the day-to-day expenses and revenues of the business. We also have another budget, which is called the cash flow budget, that will help us manage the inflow and outflow of cash, ensuring there's enough liquidity to meet the financial obligations when they come due. As we all know, not all the expenses are cash expenses, not all the revenues are cash revenues, and accordingly, planning and reconciling the cash flow activity is definitely of primordial importance in order for us to predict our cash needs and our cash funds availabilities in the upcoming periods. However, before we dig deeper into these categories, we need to examine at first the financial statements, which are a very crucial part of every financial exercise. In this segment, we'll explore 4 fundamental financial statements that are crucial for understanding the financial health of any organization: the income statement, the balance sheet, the statement of retained earnings, and the cash flow statement. Let's start with the income statement. This financial statement provides a snapshot of a company's profitability over a specific period, usually a month, a quarter, or a year. The key components are definitely revenue, which are the total sales or the income generated in that period of time. The expenses that the company has incurred to generate that revenue. We start initially with the cost of goods sold, and then we trickle down to the operating expenses. And eventually, after removing the interest and the financing costs and the tax effects, we end up with the net income. And the net income eventually is the difference between the revenues and expenses. The income statement is like a movie, capturing the financial performance of a company over time. And actually, the income statement is the first input that is going to be feeding into the next financial statements. So accordingly, let us talk, once we have finalized this, let us talk about the statement of retained earnings. The statement of retained earnings takes into consideration the net income that we have seen in the income statement and takes the net income that has been generated and divides it into 2 parts. The first part is related to the dividends, or which is also known as a thank you for the shareholders that have been investing with us since the beginning of the company's initiation. And accordingly, it will also divide the retained earnings, so the money that stays in the company from the profitability. People might ask, why do we need to keep money in the company? Well, eventually, keeping money in the company is very essential for the company to grow organically. And not only that, in good days, the retained earnings will help the company expand and grow and innovate. And in bad times also, whenever the company is doing bad, having a decent amount of retained earnings on the side allow us to survive these bad times without having to recur to emergency funding solutions and emergency liquidity needs. Then comes the balance sheet. Unlike the income statement, which provides a view of performance over time, the balance sheet offers a snapshot of a company's financial position at a specific point in time. The key components of the balance sheet are as follows. The assets, obviously, are what the company owns and that can generate a future benefit out of. The liabilities on the other side are what the company owes, or that are the obligations that the company needs to fulfill in a predefined period of time. And equity, obviously, is the residual interest of the owners in the company's assets after deducting liabilities. Think of the balance sheet as a snapshot, freezing a moment in time to show the company's financial standing. A very critical rule in the balance sheet is the equivalency and the equality between the assets and the liabilities and equities section. And this is why actually it is called a balance sheet. On one side, you have the assets. On the other side, you have the liabilities and equity. What's the underlying reason behind that, actually? One might ask. Well, to make it easy and simple, in order for you to acquire any asset, you can either acquire it from your own pocket, or what we call equity, or from someone else's pocket as a loan, which what we call liabilities. And these are the only two funding options in order for us to acquire any asset. And accordingly, every asset you own has either been financed by liability or by equity or by a combination of both. And hence, the equivalency and the equality between these two sides of the equation. The cash flow statement, on the other hand, tracks the movement of cash in and out of a business over a specific period. As we have discussed previously, not all expenses are cash expenses. I'm talking about depreciation and other. And not all assets and liabilities are cash assets and liabilities. So we're talking accounts receivable, account payable, etc., etc. So reconciling the activities and the financial status of a company by managing those non-cash transactions is what leads us eventually to the cash flow statement. The cash flow statement is divided into three main components: the cash flow from operating activities, the cash flow from investing activities, and the cash flow from financing activities. Operating activities are related to the cash generated from the core business operations of a company. So buying and selling and transforming cash into inventory and selling it and paying to your suppliers and getting paid from your clients, etc. Investing activities are used for investing in cash, in assets, meaning, for example, machineries and equipment, or long-term investments like bonds, etc., or maybe investments in other companies as well. The financing activities in general are used for financing, as the name implies, obviously, like paying dividends, taking loans, raising capital, etc., etc. The cash flow statement is the lens through which we can observe the liquidity and cash position of a company. And it does help explain the increase and decrease in the cash balances as reported on the balance sheet. And it also helps assess the company's ability to generate future positive cash flows and to meet obligations and to pay dividends. But how do these financial statements relate to the budgeting? Well, the income statement helps us compare actual revenues and expenses with the budgeted figures. The balance sheet assists in projecting future assets, liabilities, and equity, aiding long-term budget planning. And the cash flow statement ensures that the budget aligns with the organization's cash position, preventing liquidity issues. The financial statements are very important in decision-making because they provide the data needed for informed decision-making, and they offer insights into the financial health of the organizations, helping managers make strategic choices. Now let us move to the section related to creating a budget. The process typically involves setting financial goals, so we define clearly what we want to achieve with our budget. We need to identify our revenue streams, so determine where our income is coming from. We need to also be estimating expenses to project our anticipated costs, and we need definitely to be allocating resources in order to distribute our funds effectively. And definitely, as we have discussed, monitoring and adjusting or regularly tracking the budget to make adjustments as needed is also very important. In order to identify the revenue streams, we need to ask, where does the money come from? What are our primary sources of income? Are there multiple revenue streams? How do they contribute to the overall budget? How reliable and consistent are these income sources? In order for us to estimate expenses, we need to be projecting our anticipated costs. So we need to divide our costs into fixed costs, or the ones that remain constant, like rent or salaries, and the variable costs, those that fluctuate, such as utilities or raw material, etc. And we need definitely to identify the one-time expenses for special projects or unexpected costs that may arise. When the revenues are identified and expenses are estimated, the next step is to allocate our resources effectively. So we need to prioritize in order to allocate funds to high priority areas that align with our goals. And it will help us also with the flexibility to allow some flexibility in your budget to accommodate unexpected changes. For accurate budgeting, we definitely need to research some historical data. We use research and historical data to inform our estimates and make them more relevant and more accurate. We definitely also need to involve key stakeholders to collaborate with relevant teams and gather insights and ensure comprehensive planning. It also helps if we have a budgeting software to streamline the process and enhance the accuracy. Now, let us explore some major approaches that are very well used and utilized globally in order to start with the budgeting exercise. The first, obviously, is the traditional one, which is called the incremental budget. The incremental budget is based on the previous year's budget or actual performance, and adjustments are made incrementally using the previous period's budget or actual, and allocation of resources is based upon the allocation from the previous period. The advantages of such a budgeting approach is that it's stable and change is gradual, and it actually makes sense. It is simple and easy to understand. It is based on real life and real previous experience in that company. Conflicts can be avoided also if departments are seen to be treated similarly in this activity. So everyone receives the same increase across the board. However, one of the main disadvantages of this is that it assumes that history is always going to continue to be the same in the future. So it assumes that activities will continue in the same way. And accordingly, it may become out of date in case there is a change or there is a serious change in the operating environment that the company is working in. Another disadvantage is that it has no incentive for developing new ideas. We are just using what we had before, and we are considering this as Bible in order for us to move forward. And accordingly, we are not trying to invalidate our previous assumptions and to retest them and to reorganize them. It also has something very bad, which is called the spend it or lose it mentality. Imagine you are a cost center and you are expecting that next year's costs allocated to your department should be aligned according to an incremental flow, in the sense that next year the budgets or the expenses will be more than what you have planned for this year. Do you have any incentive to keep money that is not spent? Obviously not. So the departments will thrive and run to spend all the money available so that next year they will have more money to allocate and to spend. And accordingly, all of these reasons may help into the incremental budgeting, creating a budgetary slack. Another approach to budgeting that tries to solve the disadvantages that we face at the incremental budgeting is called the zero-based budgeting. The key features for this is that the budget starts from zero at each period. It requires justification for all the expenses that the company is going to undertake, and it encourages a thorough review of all activities and costs. It promotes cost efficiency and strategic thinking, and it has no use of prior year's performance. We need to examine every time all the costs in the hope that some of these costs can be reduced or eliminated. The advantages are obvious because the budgets are flexible and they are focused on operation and deep analysis of every related cost, and it would eventually lead to lower costs and defects and detects inflated budgets, and it definitely better aligns budget with strategies. However, the disadvantage is that it may be manipulated by managers and it may reward short-term thinking. It is resource intensive and it needs a lot of effort and time to prepare. And to be honest, quite frankly, you don't need every year to reinvent the wheel. So sometimes this is efficient for sure, but sometimes it may need to be taken in particular years or in particular sides of the business rather than implementing it every year to all aspects of every business and budgeting exercise. The third methodology is called Kaizen budgeting. Kaizen budgeting is a Japanese terminology, and it is based on the continuous improvement, which means that we are hoping to eliminate the waste in our processes in order for us to achieve a better yield or a better result considering our existing resources. The advantages of this are definitely obvious as well, because it is a proactive setup and it establishes a continuous improvement mentality on the company. Means that at every budgeting exercise, we can find and we will be thriving to find ways to improve our cost structure and to eliminate the waste that we have. Disadvantages, however, is that sometimes lower quality level or cheaper labor markets are encouraged in order for us to decrease the cost. However, they may not be the best solution for us in the long term. So maybe some cost-cutting measures that help improve the cost structure, however, without improving the quality of the products or the productivity, may be taken into consideration in order for us to consider that we are continuously improving. And obviously, this is not ideal. Another one, or fourth methodology, is called activity-based budgeting, also referred to as output-input budgeting. So the activity of the company is not divided into a total production, for example. It is divided into several parts of that production. So, for example, product design, product implementation, product coloring, product inspection, product marketing, product sales. So eventually, we divide our final exercise into several activities, and we try to allocate the cost for each of these activities. Obviously, the advantages are clear in that approach as well, in the sense that we will know for sure which activity is costing us a lot of money and which is costing us less, and we can identify based on this what is our value-added activities and what are the non-value-added activities, and accordingly we can try to prioritize our resources accordingly. Well, how do we know which one is the right methodology for us? The key is to choose the right one for your organization's unique needs. So we need to consider factors such as industry dynamics, organizational culture, and the level of uncertainty in the business environment, or even the business lines and the maturity of these business lines. So there is no magic bullet in the sense that one solution fits all. Sometimes we may use one type of or one approach of budgeting. Sometimes we may use several in working together. So it all depends on your specific organization, and there is no deep right and wrong solution in that aspect. Some common challenges in budgeting are setting overly optimistic revenue projections, or underestimating expenses, or the absence of contingency planning or margin of maneuver, insufficient stakeholder involvement, static or rigid budgets that do not move and do not change whenever the underlying situations or environments change, inadequate documentations in the sense that could lead to confusion and make it difficult to hard changes, or sometimes all in all, ignoring historical data is a big problem as well, because historical data, although not always necessary in order to predict the future, however, it does provide a certain type of knowledge and understanding of whatever could be happening in the future. Sometimes also the pitfalls in order to implement a successful budgeting exercise is neglecting the technology integration in that exercise, or overlooking some external factors, or focusing only on short term, or inadequate training for budget managers, or ignoring the performance metrics, underestimating the time required, failure to learn from past mistakes, ignoring feedback from frontline staff, overcomplicating the process, or even inconsistent review and monitoring. Before we conclude this, I would like to take a moment to answer any questions that you may have. So please feel free to use the chat in order to participate in that discussion. Okay. Thank you very much, everyone, for your presence in this webinar today. And I am always available. Oh, we have a question. Oh, thank you, Srikant. Thank you very much. Thank you very much, my friends, for your attendance. I hope it was beneficial for you. And definitely, I am always available. Let me share with you the first slide in which I have my personal email and my personal number. So please feel free to reach out to me for any information or requirement that you may have. And eventually, yes, for sure. Please do share, everyone. Please share your emails with me in the chat so that I can forward this presentation to you, everyone. And please feel free to reach out to me whenever you want in order to explore any ideas that you may have, or even have a smart discussion together about what you think is the right approach to do so. Definitely, my company, the company that I'm representing, Merck, provides several solutions in that respect. So also, if you are interested in exploring any of those, please feel free to reach out to me on the email and on my phone. Thank you very much, everyone.
Merck.com